This fund seeks to hedge interest rate movements stemming from rising long-term interest rates. Hello, my name is Marc Drouinaud Jr, and if you're new here, I do cyber-related videos. Please feel free to relax and enjoy the content. Like this video, comment on this video, hit the notification bell so you know when I am uploading new videos, and subscribe to this channel. This is Finance Fridays. We're about to get into it. ETF funds, let's get into it now. An exchange-traded fund, ETF, is a basket of securities that trades on an exchange just like a stock does. ETF share prices fluctuate all day as the ETF is bought and sold. This is different from mutual funds, which only trade once a day after the market closes. ETF can contain all types of investments, including stocks, commodities, or bonds. Some offer US-only holdings, while others are international. ETFs offer low expense ratios and fewer broker commissions than buying these stocks individually. ETF Fund 1, we have Invesco DB Commodity Index Tracking Fund. In an inflationary environment, this Invesco ETF offers both a hedge fund against rising prices as well as a simple way for investors to capitalize on this trend. This fund contains a short list of the most popular global commodities, including energy goods like crude oil, metals like aluminum, and grains like corn. Unlike the typical stock-based fund that plays producers, DBC is directly linked to future contracts, so you can have greater exposure to the actual movement of commodity prices instead of simply commodity-related stocks. With more than $4 billion in assets, this is a go-to way to play raw materials. And with returns of more than 30% in 2022 despite a down market, there is an obvious appeal in this ETF as we enter May. ETF Fund 2, ProShares K1 Free Crude Oil Strategy ETF. Many investors have been looking for MLPs or Master Limited Partnerships in 2022. Generally speaking, this special class of stocks consists of energy infrastructure plays that have upside potential thanks to the current inflationary environment, as well as generous dividends. The catch, however, is that the partnership part of the MLPs makes for some cumbersome paperwork, including a complex K1 tax form that baffles many investors and even some accountants. This ProShares fund takes that hurdle out of the picture by offering diversified exposure to oil-related partnerships in a form that doesn't require you to get that dreaded K1 form each year. It's appealing. It's an appealing vehicle for this reason alone, but the 40% return so far in 2022 make it look even better right now. We have ETF Fund 3, Invesco Dynamic Energy Exploration and Production ETF, a focus list of about 30 energy stocks. This Invesco fund is concerned mainly with oil field service and exploration stocks, and unlike some of the market cap weighted funds in the space that are biased towards big names like Halliburton Company or exclude integrated oil companies because they are one-dimensional production plays, PXC takes a more active approach to lap into the very best performers based on current conditions. The tailwind for oil prices has been nice for the entire sector, but this active ETF has outperformed even the broad uptrend with an amazing 40% gain year to date thanks to components including Comstock Resources Inc., CRK, Occidental Petroleum Corp., OXY, and others. We have ETF Fund 4, iPath Series B, S&P 500 VIX short-term futures, ETN. VXX, which is technically an exchange-traded note, isn't a play on the stock market exactly. Rather, it's a bet on volatility itself. VIX is the ticker symbol for the CBOE Volatility Index, also known as the Fear Index by many traders. The VIX is linked to the S&P 500 option trading and is therefore an indicator of future moves in the market. Therefore, this iPath fund is tied to short-term investments in that index. So it rises when traders start to worry about what's going to happen in the immediate future. Given all the near-term volatility and uncertainty that persists, this continues to look like a wise bet as we enter May on shaky footing. If volatility continues, VXX could build on its already impressive returns of about 50% year to date. ETF Fund 5, Simply Interest Rate Hedge ETF, PFIX. Worried about the impact of rising rates? PFIX has you covered with an approach that is tailor-made to profit from the changing market dynamics brought on by the current environment. This fund seeks to hedge interest rate movements stemming from rising long-term interest rates and to benefit from market stress when bond market volatility increases. PFIX does this in large part through interest rate options, an investing vehicle that is complex and difficult for investors to assess otherwise. The results are amazing, 55% in profits via this approach in 2022 so far. So that was the 5 ETF funds. Let's fatten our wallets. Thank you for watching this video. If you like this video, click the thumbs up button right below the video and subscribe by clicking the big red button right below the video. Also, if you enjoyed this video, then you will probably enjoy these videos that's on the screen right now. So if you click on the screen right now, you can watch those. Do you have an ETF fund you want me to cover? Finance Fridays? Write it in the comment section below. Also, click the notification bell next to the subscribe button to get notifications when I upload new videos. Lastly, please feel free to watch other videos on this channel. You don't know how to subscribe? I'm looking right at you. I have a dark blue shirt. I'm smiling. Click on my face. I'm smiling with my dark blue shirt. Click on that. All right? Stay safe, Hack Pack. Finance Fridays. Please feel free to watch, like, and comment other videos on this channel. Subscribe now.